Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. But today we're going to go through Twitter, see what people are sharing on social media. It's generally related to three different topics: wealth building, commodities, and/or financial topics. I'm going to interject my financial opinions as we go, which I'm loaded with a bunch of different opinions. And let's see what people are sharing on social media. If you want to follow me, it's at finding_finance. And if you want to join our community, finding-value.com. I dive deeper into these topics, deeper into individual companies to see what is available to potentially invest in. We have a question and answer session coming up at 5 p.m. on Sunday, Mountain Time, and we still have a coupon code going on. May Day is still active. You can still use it, even though it's June 1st. And it's still good for 50% off first month and first month only, and a larger discount on the yearly membership if you're interested in a yearly membership. So going into Finding Value Finance, oh, look, that's me. Could XLE get going here? XOP doesn't look bad either. Neither does some of the other ETFs that I follow in the energy sector. So looking at these charts, XLE is right at the top there. I threw a line across. This could be a throw over top and a big pullback. We're coming up. We had a lot of resistance through here, and we've got two small down candlesticks signaling that the resistance is being supportive. If you zoom in on it, you can see this pullback, and we got a nice big green candlestick today. Is this the beginning of a potential move to the upside for oil and gas stocks? Or even maybe crude oil might follow along with it. Are people positioning before the move? We are also seeing something very similar in XOP as well. I call this confluence of evidence, or the merging of different evidence to come to a conclusion. XOP is a little bit more exposed to the smaller oil and gas companies versus XLE. So XOP, and we are right up above the neckline of a big inverted head and shoulders. And we have just started to break out of a trend line on XOP to the upside. So as soon as I start to see bullish formations start to break, I start to become bullish and I start digging into the individual companies' chart patterns. Those chart patterns and of the individual companies, if they look good, then we might find potential buy points. And I'll be going over some of those potential buy points and what I like in the market during that question and answer session on Sunday. What I think are potential opportunities and why I think they are potential opportunities. Scrolling down, we've got power on demand at 2.9 watt hours per ChatGPT request. AI queries are estimated to require 10 times the electricity of traditional Google queries, which use about zero point 0.3 watt hours each. Wow. So AI, this thing that is so great that's going to come, requires 10 times the amount of electricity of traditional Google queries. Now, here's another thing that I just want to make a side comment. We have a system, we had some systems that were going and were being implemented at the work that I used to work at. And as time progressed on, what I saw and what I experienced from my experience as an engineer, we did engineering change orders, and when I first got there, we could get one through in literally 5 minutes by hand. It was a paper engineering change order. Then we went to a hybrid system where we had paper and I had to put it in the system. That was like 15, 20 minutes worth of work, which used to be 5 minutes worth of work. And then we went into a full electronic engineering change order system, which took like a half hour to an hour to put everything. And then it would send it electronically through the system. And then we went to even another system that took like an hour or two to put everything in because you had to put it in two different systems. This seems eerily similar to that. I'm not, these queries, I don't think AI is that great. I mean, maybe we get better answers through the queries, maybe, but I'll hold my judgment at this time. But my experience from using a lot of technology in work, things got a lot less efficient, not more efficient. So we'll see if AI can, these queries are more efficient. We'll see. We'll see if the answers are that much better while it consumes 10 times the amount of electricity. Christine says, nice breakdown of fuel demand expectations from Wood Mackenzie showing. So EVs and hybrids aren't expected to hit gasoline demand until after 2030, and the outlooks for other sectors remain robust. It also assumes that all EVs have autonomous driving as a key driver for consumer adoption. That's kind of interesting. I didn't really look at this chart down here. I was just kind of reading that they don't expect gasoline demand to really get hit till after 2030. I don't want to go through all that, but that looks interesting as well. So Eric Nuttall says, despite having absorbed 224 million net barrels from the Strategic Political Reserve over the past 1.5 years, global oil inventories now sit just 6 million barrels away from record deficit levels. With OPEC plus cuts likely being rolled, where did it go? Being rolled to at least Q4 of 2024, we see days of supply hitting record lows, suggestive of $90+ Brent by year end of 2024. With U.S. shale growth falling, will and intent winning, and demand growing longer and stronger than consensus believes, we remain bullish. So global observable oil inventories, there's 2024. We're right here just above this low point, which is 2018, it looks to be. We've got global oil days of supply forecasted to drop, which would be at very low number of days of oil supply, 540 it looks like. And then global observable oil inventory onshore and oil on water, he has it projected dropping dramatically going forward. And then the U.S. Big Three crude, gasoline, and distillate inventory levels are on the lower end of the 5-year average, a little bit below the 5-year average on the lower end over the past few years. So is this the beginning of a move higher in oil? The equities would suggest so, XLE and XOP, and maybe even some of the other equity ETFs. Oil equity ETFs, I should say. Jamie Dimon sold 183 million in JP Morgan shares this year, something he's never done before. He claims it's for financial diversification and tax planning purposes. I think there's potential for a massive correction before the end of this year. What do you think? It's possible. I mean, that's all I'll say is it's possible. I don't see the 2-year yield dropping, and I don't see the yield curve on inverting, which makes me think that we're not going to get a slowdown in 2024. That's my opinion. So I'm in the camp where the insiders kind of know when they're going to pull the plug. And if they're going to pull the plug, you'll see them position in the 2-year yield, and you'll see the yield curve on invert with the positioning in the 2-year yield. We don't see that yet. And that usually takes a little bit of time before they pull the plug. Like you'll see that on invert for a little bit, and the 2-year yield drop for, some 6 months or 8 months or a year or something like that before it really hits it. So I'm in the camp. Yes, a lot of these people sold out. Bill Gates, Zuckerberg, Bezos, like all these well-known guys, they're all interconnected with probably the insiders at the banking system and stuff and government. But they have to sell kind of before and have people forget about it. They can't sell like right before it drops. So I think they kind of are positioned a little bit earlier than maybe when the drop will actually occur. Here's oil. It says sellers beware. Speculative short positioning is at levels not seen since COVID of 2020. So this is Brent crude shorts surge, managed money short contracts at 3-year high. And this is generally indicative of a bottom. You can see we bottomed in 2020 here, and then we came back. Looks like we have a little bit of a breakout to the upside, and it's probably going to bottom here at some point and roll on lower, which means oil prices will probably go higher. SPX and SPY, the diamond target hits. Also, another three of the targets from the bear wedge in the red have been hit as well. And this is the S&P 500 pulling on back here, hitting some of the targets, I guess, that this guy has from this diamond wedge that we've broken to the bottom of. While the Chicago PMI just dropped to outright recession levels. After spending and also disappointed in core inflation cooled, all the Federal Reserve now needs is a weakish payrolls number, and the door to rate cuts will be opened on June 12th. So this is the Chicago PMI manufacturing index, all the way down here to recession levels. So maybe we bottom here, and maybe they're going to lower rates. I mean, we'll see. If they lower rates, I mean, maybe that's why I'm seeing all of these breakouts in falling wedge patterns, breakouts of the falling wedge patterns across the board in commodities. Maybe that's why I'm seeing all of that. Maybe we're going to get a big move in commodities when those rates get lowered. And maybe that's why gold and silver are breaking to the upside. It's all kind of agreeing or pushing my opinions towards a potential rate cut at some point. Now we just have to watch the 2-year yield. If the 2-year yield starts to dive to the downside, a rate cut is most likely coming. That's what we need to watch. Eric Nuttall says, oil markets false narrative number 2, U.S. shale production is surging. And that's not the case. This was U.S. shale hypergrowth over here, and you can see the new normal is a lot lower than the hypergrowth back in 2018. Another narrative says oil market false narrative number 1, demand is weak. And then we can see all-time high number of passengers pass through TSA checkpoints at U.S. airports last weekend, as that's moving on higher and higher from 2020. Christine says, so if 450 wells are completed in the Permian each month per EIA, that means less than $70 a barrel break-even wells are going to run out in 33 months, less than 33 months. And $80 per barrel break-even wells, they're going to run out in less than 41 months, which is, I mean, they're talking about running out. So we're probably going to see, I'm curious to see what production does over the next few years. Ted says, how much inventory is left in the Permian? In the Midland Basin, we come up with nearly 25,000 locations left. But the economically viable locations drop dramatically with price. So he says, let's dig in. For the latest study update, we used a data-driven approach to fill the undrilled locations. So I'm not going to go through all of that, but this is how much Permian inventory is left, and you can see the number of locations. As Novi modeled, Midland Basin inventory counts vary widely by price. Only 3,206 well sticks break-even are less than $50 a barrel, but over 15,000 break-even at $70 a barrel. And she's just responding to this information here saying, with less than 70 per barrel break even, wells run out in less than 33 months, and that's 2.5 years. 2.5 years at oil less than 70 a barrel. That's crazy to think about. And, we're in the 70s right now, and we're probably at a bottom here, guys. Because, I mean, this is the cost curve right here. The cost curve for the basin here, the Permian. Goldman on copper and commodities. Let's take a quick look at this. He says, we remain selectively bullish commodities because 1, demand growth remains solid. 2, we see more structural upside in industrial metals and gold. And 3, oil's geopolitical risk premium has shrunk. We expect commodity total returns to rise from 13% year to date to 18% by year end. I don't know how they make those type of exact predictions. 5D bull market trends. So he's got 5Ds. Disinvestment, low investment in commodities induces select tightness. Decarbonization and climate change require higher prices to attract green capex. De-risking or hedging, geopolitical de-risking, and strategic restocking support demand for gold and critical commodities. Data centers and AI support demand via power and via higher incomes. And defense spending support demand for metals and distillate fuels. They expect that copper to resume its sharp rally once finite stocks of cheaper substitutes deplete, with an additional 15% upside to 12,000 per ton by year end. They also expect that gold prices are going to rise to $2,700 per ton, troy ounce, I should say, by year end on solid demand from emerging market central banks and Asian households. So that's their views. I don't really have a big opinion on this, but that's their views. I enjoy the ever increasing cost of living. This is the US Core PCE price index since 1959. What we're looking here is the rate of change on the bottom. So this is but the 7-year rate of change gives better clues to what macro cycles we are in. So 68 acceleration all the way up to 1982, and then it started to turn over and decelerate in 82. This was your declining interest rate environment here. This is your increasing interest rate environment. Look what we have over here that occurred in 2021. They printed all that money in 2020, and now we've got this acceleration here on the right side, the 2021 acceleration line. So we've got something that could be similar to the 1970s back here, where we are going to accelerate in the US Core PCE price index. So that is something that we should probably take some attention to. You can see last bull market from 98 2000, it was just a little guy here. We got the big boy running here now. So this was the last bull market from 2000, I would say 98, 99, and it peaked in 2008. That's what the momentum looked like here. That's not really anything. Look at the momentum we've got generated here right now. That is huge, like the 70s. We're gonna come into a big bull market here, guys, for commodities. Cross-border capital, he says, our estimates of how much yield suppression, aka hidden yield curve control, is going on in the US Treasuries. Most important price in financial markets is being distorted lower by 80 basis points. So there is some sort of US yield suppression and the yield curve control going on, in their opinion, and it's an 80 bips difference in that. Here's some more information here. China hoarding copper still. This chart gets more and more bizarre by the week. China holds all the economic incentives in the world to export copper, but yet they are not doing it. What's cooking? Question mark. And this is the Chinese copper stock levels are way up here. You know, what's going on here? Why do they have so much stock? My opinion is they're not recycling money back into bonds, so they have to recycle it into something. And that something could be copper, iron ore, gold, silver, all these different things that they have to now reinvest that money into if they're not buying bonds. So if you're running surpluses, you got to put it somewhere. Where do you put it? And I don't think a lot of people have talked about that. You know, when countries buy less bonds, where does that money go? Where does it get recycled into? And isn't that larger demand for those things that they're buying? It is. Here's Grady. He says, gold, the second and final upleg of the secular bull market has started. Whatever you do, do not mess up this life-changing generational opportunity. We will have one chance at it, and only one chance. So the Huey monthly 25-year chart, gold miners ready to rip at some point very soon. He says, we bought the very lows heavily at the service, different company categories at the two different lows. So that's what he has here. It says, is it time to revisit the upper trend line of this channel? I think it is, in his opinion. The first bull market, or the first secular bull leg, was up 1,250% from 2000 all the way up to the top of that channel. He thinks that maybe potentially a 1,250% secular bull is coming for the second leg. I'm positioned in it, and we are positioned in some of these companies at the website that I wrote. So uranium, CGN Mining, what a monthly close, just ripping to the upside for CGN Mining, which is a uranium company, and they may mine a couple of other things too, but it's looking good. Squeezing on up. Kevin says, this is the key trade of the next 10 years. Tech is stupidly overvalued. Commodities are dirt cheap. I agree, and I think the market conditions are going to drive commodities up and technology stocks down. JSG says, bearish EIA data this week. Total commercial petroleum stocks are up 13 million barrels. Wow, what a start to the bullish first quarter morphed into a bearish second quarter. Second quarter historically builds, but MAG of build already exceeding second quarter of the 10-year average. So WTI fair value of $74. We're $4 overvalued based on current prices for the dot plot in commercial inventory. Just an FYI. And that's where you see the difference. You can see this data here. It says we're $4 overvalued, but we're seeing positioning in XOP and XLE, which makes me think that we're going to go higher. I know. Gotta agree with the charts. And that's what we've got for today, guys. That's where I'll end it. So give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you guys want. And that's all I've got. So we'll catch you next time. This is Finding Value.